A strange thing is happening in the silver market right now. Not in the price, not in the headlines, and not in the places most investors are looking. But if history is any guide, what we're seeing today has appeared before some of the most important liquidity squeezes in modern financial history. And the reason this matters is simple. By the time the crowd notices it, the opportunity may already be gone. Because silver's real crisis doesn't begin when vaults are empty. It begins when confidence starts to disappear. And there are signs that process may already be underway. Now, that doesn't mean silver is about to skyrocket tomorrow. It doesn't mean a shortage is guaranteed. And it certainly doesn't mean every prediction being made online is correct. But it does mean that something far more important may be developing beneath the surface. A shift in liquidity, a shift in incentives, a shift in behavior. And throughout history, those shifts have often mattered far more than the headlines everyone was watching at the time. Stay with me, because by the end of this video, you'll understand why some of the smartest market participants are paying close attention to liquidity, why margin squeezes tend to catch investors off guard, and why the next chapter in silver may have very little to do with silver itself. Before we begin, if you're interested in understanding markets from a deeper perspective, not just what is happening, but why it's happening, make sure to like this video and subscribe to the channel. Most people follow headlines. Our goal is to understand the forces behind them. Now let's begin. One of the greatest misconceptions in investing is that markets move because of news. Every day, headlines tell us why prices moved. A stock rose because of earnings. A commodity fell because of economic concerns. A currency strengthened because of central bank comments. The explanations sound convincing. But if you study enough market history, you start noticing something strange. The biggest market moves are rarely caused by the event everyone talks about. They're caused by conditions that were developing long before the event occurred. Think about an avalanche. People often focus on the final sound, the final movement, the final collapse. But the avalanche wasn't created in that moment. The instability was building for weeks, maybe months. The final trigger simply revealed what was already there. Financial markets work in much the same way. The visible event attracts attention. The invisible conditions create the outcome. And among those invisible conditions, one factor repeatedly stands above the rest: liquidity. Liquidity sounds complicated, but the concept is simple. Liquidity is flexibility. It's access. It's the ability to move capital efficiently through a system. It's the ability to respond when circumstances change. And when liquidity is abundant, almost everything appears healthy. Investors become confident. Risk-taking increases. Credit expands. Asset prices rise. Economic activity accelerates. Optimism spreads. In fact, liquidity is so important that when it's plentiful, people often mistake liquidity-driven growth for permanent growth. They begin believing the environment itself has fundamentally changed. But cycles have a way of reminding people that conditions matter, because every period of easy money eventually creates behaviors that become difficult to sustain. Every expansion creates excess somewhere, and every excess eventually faces a test. The interesting question is never whether a test will come. The interesting question is where the pressure has been building. And right now, many investors are beginning to ask whether pressure is quietly building inside the silver market. But before we answer that question, we need to understand something even more important, because this is where most people misunderstand financial markets entirely. The real danger isn't the lack of assets. The real danger is a lack of liquidity. And history provides countless examples. In 2008, there were investors holding portfolios worth millions of dollars. Some owned real estate, some owned stocks, some owned valuable businesses. On paper, many of them were wealthy, yet some still failed. Why? Because they didn't have enough liquidity. They had assets, but they lacked flexibility. And when flexibility disappears, behavior changes very quickly. If you're finding this valuable so far, take a moment to hit the like button. It helps this channel reach more viewers who want deeper market analysis rather than surface-level commentary. Now, here's where the story becomes much more interesting. Most investors believe that if they own a good asset, time will eventually reward them. And often that's true. But there's a hidden assumption inside that belief. The assumption is that investors will be able to hold long enough for the thesis to play out. Unfortunately, leverage changes everything. Leverage is one of the most powerful forces in finance. Used carefully, it can increase returns. Used recklessly, it can create vulnerability. But regardless of how it's used, leverage creates dependence. The moment borrowed money enters the equation, flexibility begins to shrink. Imagine two investors. Both own the same asset. Both have the same outlook. Both believe the asset will rise over time. The difference is that one owns it outright. The other uses borrowed money. If volatility increases, they experience completely different realities. One investor can remain patient. The other may be forced into action. And that difference matters enormously. Because markets don't always move because people change their minds. Sometimes markets move because people lose their options. That's what margin pressure does. It turns preference into necessity. It turns strategy into survival. And when enough participants face those pressures simultaneously, a margin squeeze begins. What's fascinating is that margin squeezes often create some of the most confusing periods in financial markets. Because the assets being sold aren't always the weakest assets. They're often the most liquid assets. Think about that for a moment. People don't necessarily sell what they dislike. They sell what they can. They sell what's easiest to convert into cash. And that's why some of the strongest assets can experience tremendous volatility during periods of financial stress. Not because confidence disappeared, but because liquidity became more important. Now let's connect that idea to silver, because silver occupies a position unlike almost any other asset. Silver isn't simply a commodity. It's not simply a monetary metal. It's not simply an industrial input. It's all of those things at the same time. And that's what makes it so unique. Industrial manufacturers need silver. Investors buy silver. Traders speculate on silver. Long-term holders store silver. Different groups participate in the market for completely different reasons. Most of the time, those motivations coexist without major problems. But during periods of uncertainty, something interesting happens. The motivations begin to diverge. Some participants seek profits, others seek protection, some seek exposure, others seek ownership. And that's where the story becomes increasingly important, because markets function smoothly when confidence is abundant. But confidence itself is one of the most misunderstood forces in finance. Most people think markets trade assets. In reality, markets trade confidence. Confidence that contracts will be honored. Confidence that obligations will be fulfilled. Confidence that liquidity will remain available. Confidence that the future will resemble the recent past. As long as that confidence remains strong, systems operate efficiently. But when confidence starts changing, behavior starts changing. And behavior is what ultimately moves markets. This is where history becomes an extraordinary teacher, because while technology evolves and economies change, human behavior remains remarkably consistent. Fear, greed, optimism, pessimism, confidence, doubt. Generation after generation, these forces continue shaping financial outcomes. Every major debt cycle follows a surprisingly familiar path. At the beginning, confidence grows. As confidence grows, borrowing increases. As borrowing increases, leverage expands. As leverage expands, vulnerability increases. And eventually, something challenges the assumptions supporting the system. That challenge doesn't need to be enormous. It simply needs to reveal existing weakness. Once that happens, the process reverses. Risk tolerance declines. Liquidity becomes valuable. Participants become cautious. And suddenly everyone starts paying attention to factors they previously ignored. One of those factors is liquidity itself. This is why some experienced investors spend less time studying predictions and more time studying incentives. They're asking different questions. Where is liquidity moving? Where is pressure building? Where are participants becoming dependent on favorable conditions? Where is confidence strengthening? Where is confidence weakening? Because those questions often reveal more than headlines ever will. And if there's one lesson that market history teaches repeatedly, it's that the crowd usually notices pressure after it becomes visible. The most successful investors try to identify pressure before it becomes obvious. Not because they're smarter, not because they possess secret information, but because they're studying causes instead of consequences. They're observing conditions rather than events, and conditions matter a great deal. If you've watched this far, comment the word liquidity below. I want to know how many viewers believe liquidity, not price, is the real story investors should be paying attention to right now. And if you're enjoying this analysis, subscribe to the channel because we're just getting started. Now let's take a step back, because the biggest lesson in this discussion isn't actually about silver. Silver is simply the lens. The larger lesson is about systems. It's about understanding how pressure accumulates. It's about understanding how confidence shifts. It's about understanding how incentives influence decisions. And it's about recognizing that major changes often begin beneath the surface long before they become visible. The crowd usually focuses on outcomes. Successful investors focus on forces. The crowd asks what happened. Successful investors ask why it happened. The crowd reacts after the fact. Successful investors prepare beforehand. That's the difference. And that difference can become incredibly valuable during periods of transition, because transitions create uncertainty. Old assumptions stop working. New realities begin emerging. Volatility increases. Narratives compete. Confusion grows. Yet these periods often contain some of the most important opportunities. Not because they're easy, but because they're misunderstood, and misunderstanding creates inefficiency. The greatest opportunities rarely emerge when everyone agrees. They emerge when perception and reality begin moving in different directions. That may ultimately prove to be the most important takeaway from today's discussion. Not whether silver rises tomorrow, not whether silver falls next month, but whether investors are paying attention to the forces beneath the surface, because those forces shape everything that follows. As we move into the years ahead, continue watching liquidity, continue watching incentives, continue watching confidence, because markets are not machines. They are systems of human behavior, and human behavior changes when pressure changes. The people who understand that principle often find themselves seeing shifts before they become obvious, not because they can predict the future, but because they understand how systems behave. And that understanding is one of the most valuable advantages any investor can possess. If you found value in this video, make sure to like it, subscribe to the channel, turn on notifications so you never miss future market insights. Share this video with someone interested in economics, investing, or precious metals. And let me know your thoughts in the comments. Do you believe the real story in silver is supply and demand? Or do you think liquidity may be the hidden force that investors are overlooking? I'd love to hear your perspective. Thank you for watching, and remember this: the biggest market moves rarely begin where everyone is looking. They begin where almost nobody is paying attention, and by the time the crowd sees them, the story has already changed. I'll see you in the next video.